Okay, so we've just had the latest data come out from the Office of National Statistics on average house prices across the UK, and this is pretty interesting. Listen to this. So, if you remember in the last video, UK house prices were sat on average at £294,598. Now, that was the last number from August, and now we've actually got September's figures, and the latest figures are £294,559. So, well, that's not exactly a shocking number that's worth reacting to on a YouTube video, is it? However, this lagging data, which we only get more than a month late, might be hiding some more secrets to what's actually to come in the housing markets. And I think my last video missed some key bits of information that we really need to get stuck into now. And also, once we've looked at the new data, it's definitely worth asking the question what you can actually do if you're a first-time buyer right now. So stay tuned for that. Okay, so a key point in my last video and a key driver to the housing market in the UK is affordability. In its most basic terms, can new first-time buyers afford to buy a house? Can they save up for a deposit? And then secondly, can they afford to pay a mortgage? Now, for the last decade or so after the global financial crash, interest rates have been really low, as you'll know, meaning that mortgages have also been really competitive, pretty much to the point where you could say that money's been almost free to borrow. Almost anyone out there who could afford to pay rent could technically afford to pay a mortgage. Obviously, they still have to save up for a deposit, but enough people were coming onto the market to keep those prices nice and high. Now, we've just had a couple more interesting bits of data that were well worth paying attention to hot off the press. The first one is average wage growth, and then the second one is that pesky inflation data. On wages, we did see a rise of 6% across 12 months from September 2021 to September 2022. And that was actually a decrease month to month of 0.1%. So it sounds pretty good if you think about it, but as we know, if your income goes up but your costs go up faster, then you end up in a worse position than you started. So then this is when the latest inflation data comes in, and this week we found out that it was 11.1% here in the UK. So any wages that didn't rise by that amount means that you're effectively losing money and losing your buying power in almost every area. Now, back to why this is important in the housing market, and something that was really interesting in the comments section of the last video was a reminder that we all experience things differently, including the likes of inflation, and it makes total sense. If you work at home in a technology job and hardly drive with no family support, what you feel from inflation is going to be totally different from someone who does a long commute to work, has children to look after, and earns an average income, maybe employed in the public sector. And the property market's no different in this way. We're all on a different position, either on the ladder or not at all, but more importantly, our local markets are all so different. So check all this out. If we break down the UK into the respective areas, we see very different stories being played out. What you're looking at now is house prices broken down per country. So you've got England, Wales, Scotland, and Northern Ireland. As you can see, England has the highest prices on average, and no surprise there really, because of course you've got London there and all the southern regions which really push up those averages. But interestingly enough, Wales is second on the list and actually seeing quite a fast rise, as you can see here. Now, I'm not going to pretend I've got any expertise here about why that might be happening, but if anyone does in the comment section, certainly let me know. Are you getting more second homes being purchased, or maybe even more people moving from expensive areas in England to work remotely and certainly a much nicer environment? Moving on then to Scotland, you can see it's also had quite a steady rise, now just ticking lower like England. But then check out this as an observation. Northern Ireland actually remains at a lower average price than from the peak of the Great Financial Crash. How wild is that? I didn't know that at all. That would have definitely hit some people really badly there, I imagine. Anyway, sticking on the topic of affordability, if you then ask the question, how much difference does your location play? I think this gives us a much better indication of that bigger picture. So let's pull up this data which shows house price to earnings ratio. So this is the amount that an average house will cost when compared to your salary. So for example, if you have 30k salary and the average house was 120k, then your ratio would be 4. So no surprise guessing that London sits here right at the top with an eye-watering 9.7 times earnings, followed by pretty much anywhere in the southeast, southwest and east of England. And still some pretty high numbers even when you head out of the south, head up to the Midlands, and then even further up to where I live in the northwest in Manchester. It's only when you get to the northeast where the numbers look a bit more reasonable, and that takes me back to the good old days of when I went to Newcastle University. Now remember, this doesn't tell the whole story, because you would expect that some higher paid jobs in London and the south, so technically you'd have to compare an average London salary with an average Manchester salary, I guess, to really compare those differences, but still it points a pretty bleak picture. Now, as a reminder, you might be thinking, okay, well, what's a good ratio? Is this expensive or is this cheap? Because of course houses will likely rise in price. It's just a supply and demand story. Well, for new buyers, you can normally expect to borrow 4 to 4.5 times what you earn as a mortgage. So if you're short on the total buy price, anything else is going to have to be made up with a great big deposit. So You'll either have to save up for a long time and hope you save faster than the house rises in value that you actually want, or you're going to have to speak to the bank of mum and dad and get a whopping load of cash. Now, in the last video, I brought up this key data from Nationwide, who are one of the biggest providers of mortgages in the UK, and this chart I think is probably one of the most important. It's well worth showing again just to put things into perspective, because affordability really is key, especially for those first-time buyers who make up around half of all buying on the market. As you can see here, the long-term average, which is the grey line, shows us that people spend on average just under 30% of their take-home pay on their mortgage. But with mortgage rates being as high as they are now, we're potentially about to enter into a dangerously high level. And looking back on history through the dot-com crisis and the global financial crash, once people start to have to pay more than 45% or so of their take-home pay on a mortgage, it looks like the rest of the system breaks and something has to give way. Okay, so what else did we miss in that last video? Well, another part of the supply and demand equation that I didn't really speak about is actually something I saw in the news very recently. Now, this might not apply to all areas of the country, but certainly in big cities like London get this pressure, and I'm definitely aware of it in Manchester too with all of the major building work going on. And that's foreign buyers, because don't forget, as the US dollar has got stronger and we've seen our pound fall in value, our property in the UK, especially in popular areas, is looking to some people like a nice fat discount. I'll have to find the right article again and get it up on screen now for you, but it was saying how a high-end estate agent in London had sold multiple homes in the tens of millions of pounds mark each in the last couple of weeks when the article had been written. Now, the reason I bring this up is just another reminder that each of our experiences with property is going to be unique depending on where we live and what we're looking for. Of course, not all of us have got millions to spend on a house, but either way, the more buyers in the market and the less supply there is, especially in a place where building new homes isn't going to be very easy, then this will keep putting that pressure on especially those first-time buyers who haven't yet got their foot on the property ladder. Now, the challenge is saying, at what point does it break and at what point does demand fall? Well, I've got no idea, but it's obviously a very careful balancing act of supply and demand. And certainly over the next couple of years, the Bank of England and other economists don't think we're in for a very good ride when it comes to growing our economy, and a potential recession is already looming, as if we're not already in one. Now, all that will do is put more pressure on wages, reduce that key affordability, and potentially then you've got a melting pot that just boils over. But honestly, none of us know exactly what will happen, and making predictions about the future is hard, as the famous saying goes. So instead of making predictions, as promised at the beginning and brought up in the comments on the last video, what practical steps can people do now with the mortgage rates and house prices the way they are actually in real life? Well, there'll be plenty of you out there looking to get on the ladder, and you're probably quite close to being able to pull the trigger, and you can actually afford the payments of the mortgage too, even at the current levels. If we just check what we're looking at right now, here's two different providers just for some research. I've been looking at HSBC here and Nationwide too. On the HSBC side, here are their latest mortgage offers, and you can see that at least on the fixed side, you're looking at almost 6% if we assume you can deposit 15% in your first home. And this does fall slightly if you fix it for a little bit longer. Now, quick shout out to our international viewers who can get a 30-year fixed mortgage. I think we would have all grabbed those in the UK if we could at 2% a couple of years ago, but sadly, that's not how it works here. Same pretty much on the Nationwide side. At a 2-year fixed, it gets you about 5.74%. However, here's where we might get a little bit of relief, and shout out to the comment section in the last video for making this suggestion. If you want to get on the property ladder right now and you're in good shape, and if I'm reading this correctly, it might be better to jump onto a tracker deal just for a year or two and then see what your options are later in the future. For example, if we scroll down here, we can see that the 2-year tracker is 4.24%, and that's priced at whatever the base rate is, plus that 1.24% on top. So obviously at the moment we're at 3% for the base rate. Now, if I'm misreading that or interpreting it wrong, then do let me know in the comments. And obviously I'm no mortgage broker or financial advisor, but it does look like it gives you a good option at least. I guess the gamble is always going to be, what if they raise rates again pretty quickly? Then you might have been better off on a fixed deal, but then I guess that's always the case, I suppose. Just a thought anyway, shop around and see what's best, because if you're going to be in a house for a very long time and you found something you like, I'd hate to see people miss out by trying to time the market, just like how many people do trying to time the market in the stock market. Now, just before wrapping things up on this video, I've had the UK annual budget going on in the background as I was putting this video together, and I did see that the relief on stamp duty is due to get cut in 2025. And apparently the OBR, the Office for Budget Responsibility, does expect the market to cool down a bit over the next couple of years, so that's definitely worth bearing in mind. At the moment, first-time buyers don't have to pay any stamp duty up to the value of £450,000, which covers pretty much the majority of cases, at least outside of London, and this was raised previously from £300,000. Also, on top of that, stamp duty for non-first-time buyers and those of you moving home used to have a £125,000 nil tax band, which was then moved to £250,000. So after this gets removed in 2025, if I'm reading that correctly, things will go back to those old bandings, meaning that there'll probably be some pretty hefty battles going on running up to the last couple of months before that rate change. So again, just bear that in mind if you're looking to get in the ladder or move in the next couple of years. So anyway, where does that leave us all? Well, it really does depend on where you're at and what stage you're at. And please do keep the conversation going in the comment section. It's been really great to get your feedback and hear all your stories. But my overwhelming takeaway was that you've all got different experiences, and this subject is definitely a hot potato. So hopefully I don't get my hands burnt. Supply and demand in the market is a really careful balancing act, and it could very easily swing in a bad direction very quickly if those buyers dry up or people suddenly can't afford to pay their new high interest mortgages. So many things are at play, and each region is different, as we've seen. And to add more fuel to the fire, we also saw how buyers in the US dollars are also swooping into cities, taking advantage of those currency differences. So trying to put a finger on one reason or say it's caused by one single thing, I think might just be a little bit too lazy. Anyway, that's the latest data. I really hope you've enjoyed the video. If you didn't see my last one, please go back and check that one out here on screen now, or enjoy this other video on screen. Anyway, I'll keep you up to date if anything changes in the meantime. Drop me a like on the way out, subscribe for more, and as always, happy investing.